Hi everyone, my name is Jason Less. I'm the CEO of Riot Blockchain. I've been with the company since 2017. I became CEO at the start of last year in 2021. Really appreciate everyone submitting questions today, trying to address as much as possible. This is probably going to be a pretty long video. I'd like to give the best answers I possibly can. So we're going to start diving into some questions here, and once again, appreciate everyone submitting and appreciate you guys that are now listening to the responses. What is the plan for developed but unused capacity at Whinstone? So in general, we're retaining the optionality of that capacity right now. A large part of that extra power capacity has the potential to be used up by performance enhancements from miners operated in immersion cooling. If we're able to materially increase the hash rate out of those machines, which we believe there's going to be the opportunity to, then we're going to be utilizing more power. So a lot of that extra power capacity we are reserving for those enhancements. How much of Navarro will be dedicated to premium hosting such as immersion cooling? Well, so Navarro, our Navarro County site, which is also called Corsicana, we are actually committing 100% to immersion cooling. We're planning to build 10 buildings totaling 1 gigawatt of all immersion cooling infrastructure. And the first phase of that expansion has begun, and that's 400 megawatts, 4 buildings utilizing immersion cooling. What do you believe the future mix of hosted versus self-mining will be at the new facility? You know, that's a question we get a lot, and I don't have a definitive answer on that right now. We are leaving the optionality open. That's a decision that we're going to make, and different market conditions over the next year or so will influence what that answer is. When the cost of capital is high, hosting a more capital-light business becomes particularly interesting. As a host, you're building the infrastructure and you don't have the what is the biggest component of a CapEx expense for miner, buying the miner. So if cost of capital is high, then other market conditions are impacting securing a lot of miners, then it becomes interesting to use the optionality of owning infrastructure to be a host instead. But that's something that we're going to continue to evaluate, and we will know more over the coming months here. Can you share anything about your hosting business at Whinstone? Customers, contract terms, expansion plans, how they feel, etc. So we view our business as having 3 segments. We have a self-mining business, we have a hosting business, and we have an engineering business. Our self-mining business is a customer of our hosting business. Our hosting business is a customer of our engineering business, as well as servicing external clients as well. With our pipeline of additional capacity, yes, we are looking to expand our hosting business, although I do not have definitive numbers on to what extent or how we're splitting up capacity around there yet. Now, hosting clients, particularly non-public hosting clients, are typically looking for a level of confidentiality with their hosting agreements with their host. So just as Riot's agreement with Coinmint has a number of confidentiality provisions in it with specific performance terms not disclosed, our hosting clients at Whinstone are also looking for a similar level of confidentiality. So I can't tell you all the details about those agreements. I can tell you that our largest hosting customer is a Bitcoin mining company called Rhodium. They filed an S1 to go public late last year. They did not go forward with that offering, but they are a large Bitcoin mining company. Now, asking about how do our hosting clients think about us being competitors? I think first and foremost, our hosting clients are looking for strong infrastructure providers who can build infrastructure and provide hosting services. Especially in this market right now, where there's such a shortage of infrastructure, that's the number one thing clients are looking for. Now, that being said, all miners are competing for a fixed amount of rewards. So in a sense, all miners are kind of competitors. But like I said, we are, in addition to being a self-miner, we have a hosting business as well. We are infrastructure providers, and miners without infrastructure are relying on companies like Riot to provide that infrastructure and host them. What is the recognized performance increase from immersion cooling? Now, before we publish our results for this, we view it as important to get a lot of months of data operating in different environments, increasing the performance metrics of a machine to whatever degree we decide to do that is an important decision, and we want to make sure we have a lot of data before we make that type of decision and before we start communicating those type of results to the market. I can tell you what other mining companies or researchers have observed utilizing the S19 in immersion cooling. Brains did a pretty extensive study on this, which you can check out on their blog, and using the stock power supply with the S19, they were able to increase hash rate by about 25% without any loss of efficiency when utilizing immersion cooling. As a side note, the X19 series miners are very sensitive to their temperature and how efficient they operate. So utilizing tools like immersion cooling and keeping the miners operating at cooler temperatures helps drive a low efficiency rating for those machines, which is important. Also in the Brain study, they were able to achieve as much as a 50% increase in hash rate. However, that does require using a third-party power supply. The stock power supply that comes with the S19 doesn't have that level of power capacity. So there's the potential to reach that type of performance increase as well, but it would require, like I said, a good amount of performance data first to be safe pushing the machine to that level, and also would require procuring another power supply, which wouldn't be too hard of a task to accomplish. Does Riot have any Antminer S19 Pro Hydros in operations? Do you think liquid cooling miners are the future? No, Riot does not have any S19 Hydro miners right now. Our fleet is entirely S19 series miners, either S19A, S19 Pro, or S19J Pro miners. We are very focused on immersion cooling right now, and going forward, all of the buildings that we're planning to build are all immersion cooling. So for those, you're using miners like the S19 series miners, you're removing the fans, making some other modifications, and submerging them in fluid. The hydro miners are a different approach, where there's water blocks inside and water circulated to cool those miners. That requires a different type of infrastructure, a container, and that's not the infrastructure that we're currently building, so that doesn't fold into what our current plans are. Okay, so there were a lot of questions about dilution and the ATM, or at the market offering program, so I'm going to answer that all in one response here. So first, Riot stock price is very correlated to Bitcoin, like any Bitcoin miner. And historically, the Bitcoin price has been very cyclical. It has gone up and down, but in an upward trend over its lifetime. Now, as a management team, our job is to fund our business with both internally generated and externally generated capital. We are long-term believers in Bitcoin, and that's why it's an important part of our strategy to hold Bitcoin on our balance sheet. We believe our shareholders benefit from the company having Bitcoin on its balance sheet. Now, we are not so inflexible that we will never sell Bitcoin. We evaluate our position on this frequently, and as shareholders might have noticed, we have started selling a portion of our monthly Bitcoin production starting in March of this year. So, beyond internally generated sources of capital, we move on to external sources such as utilizing debt or raising equity. And it's really critical that shareholders understand the implications of using debt in this type of business. The debt markets in Bitcoin mining are still immature. They have grown quite a bit, but they are still immature like other emerging industries, and as such, the terms are currently very favorable to lenders. And without sufficient scale to repay debt and collateral value rapidly changing, we've seen competitors in a position where they have to start selling Bitcoin to meet collateral requirements or repay debt, or in the case of using convertible bonds, the value of those convertible notes start trading at a significant discount to the face value. So when this happens, these companies can quickly find themselves in an over-leveraged position, and when you're in an over-leveraged position, your cost of raising debt and equity becomes increasingly expensive, if not impossible. And when you're in a volatile space like Bitcoin, that volatility can severely exacerbate the situation if you are over-leveraged. So Being aware of Bitcoin's significant volatility, we've observed what's happened to other companies in the space, and as such, we've chosen not to utilize leverage at this time. And so when you look at these different debt options, while they initially appear non-dilutive, the implications of utilizing leverage are now being seen by the market as these companies' equities values, companies that utilize leverage and find themselves in an over-leveraged position, find their equity values potentially now in jeopardy. Riot, on the other hand, has taken the opposite approach. We have judiciously tapped the equity markets, but not without good reason. And as a result, we are very well positioned now competitively. We have been increasing our hash rate significantly and plan to increase it even more going forward. We've expanded our infrastructure. We've taken advantage of opportunities in the marketplace for acquisitions, and we continue to evaluate those opportunities on an ongoing basis. And as a result of that, we believe we are positioned better than anyone else in the market. We have a strong, unlevered balance sheet. We are operating at scale. We have a low-cost, long-term power purchase agreement. We have an industry-leading development team, and we continue to have significant accretive growth opportunities in front of us. So we will continue to systematically evaluate non-dilutive capital options that we can layer into Riot's capital structure. But like I've been emphasizing, we are only going to proceed with options that do not directly put the company in jeopardy. It's important to us that we continue to grow and that we continue to scale, but it's also important to us that we have a sustainable business, minimizing risk as much as possible. So next question, a lot of comments about executive comp. So let me once again kind of wrap that all up in one response here. And I think there's a lot of misunderstanding about what some of the commenters are seeing on our 10K, on our proxy material for our compensation summary. So first off, substantially all of our equity compensation is performance-based. And in fact, substantially all of our compensation in general is performance-based. That means that we have to achieve specific metrics to get these awards. Now, for reporting purposes, what you see on these summary tables is the total value of these grants, the total opportunity in the program at the start of the program, at the share price at that time, which was $36 a share. The share price is obviously much less now. However, the awards are denominated in shares. These awards that we receive from this performance program are fixed denominated shares. And we are only achieving these awards if we achieve specific performance metrics. So once again, what you're seeing on the 10K, on the summary compensation table in our proxy statement, that is not compensation that we have received. Rather, that was the value of all the awards in the program at the start. So how do we achieve these awards? There's two main targets that we go after. One is building infrastructure and filling that with hash rate, monetizing that to the benefit of the company. That's significant value creation. The other is achieving different milestones of financial results measured by adjusted EBITDA. So to get the full benefit of this program, we would have to have built 1.5 gigawatts of Bitcoin mining infrastructure. So that would be, looking at the current hardware in the market, that would be about 50 exahash. And we'd have to achieve an adjusted EBITDA in a given year of 500 million. Obviously, that is significantly higher than what we've achieved in the past. So these are big targets to hit, and we only receive this equity compensation if we are achieving these awards. And I've been saying we because I think it's also important to note that this is something that everyone in our company participates in. This is not just a CEO or executive only thing. Every employee in our company is a part of this performance program, incentivized to expand our Bitcoin mining operations, and incentivized to increase our financial results. Everyone on our team plays a part of that, and everyone on our team is therefore incentivized to succeed in these goals. taking in all this information, I saw comments of, management is receiving these equity awards and only owns 1% of the company. So remember, these equity awards were not actually received. What's reported is the total opportunity in the program. So it is not that management received this quantum of awards that we no longer own. We have not earned these awards yet. And the fact is, these awards are challenging to earn. They're somewhat difficult to earn. And if we succeed on these, if we build 1.5 gigawatts of infrastructure in total, operating an estimated 50 exahash, if we achieve 500 million in adjusted EBITDA, those are ambitious goals. And in completing those goals, we would be creating significant value from shareholders. So we believe by completing these goals that shareholders would be benefiting from the result of these accomplishments. Is Riot committed to remaining solvent through a multi-year Bitcoin bear market? Absolutely. A real advantage Riot has as a team that we have is we've operated as a Bitcoin mining company since 2017. We've operated as Bitcoin has gone from 4,000 to 20,000 down to 3,500. Recently, we've been on a swing up to 69,000 and now down to about 21,000 today. So there's been a lot of swings. Those are summary points. There's been a lot of swings through that ride. So through this experience, we have learned, and it's imprinted in how we build and operate our business, that having a low cost of production is very, very important. And having a strong balance sheet with flexibility is very, very important as well. So we just finished the second quarter, and those financials will be released in August. But in our Q1 financials, we had a cash balance of 113 million, no long-term debt, and most recently we reported about 6,700 Bitcoin on our balance sheet. So we've maintained a strong unlevered balance sheet. We've focused a lot on our power strategy and made acquisitions to drive a very low cost of production. And all of these factors combined position us to survive a variety of Bitcoin market conditions very well. Any changes to the plans for buildings D&E to move from air-cooled to self-hosted immersion-cooled? Not at this time. So in our current expansion out at Whinstone, we're building 4 buildings. Two of the buildings F and G, are immersion-cooled. And when fully deployed, we believe this could be the largest deployment of immersion cooling in the entire Bitcoin mining industry, which we're very excited about. And the other 2 buildings D and E, are air-cooled buildings. Now, we do have the ability to pivot to those in immersion in the future, but what we're actually really excited about right now is this in-house racking system we've developed for air cooling, something that we've innovated that we think is very exciting, that a lot of miners are going to be interested in. So we're building D&E out with air cooling infrastructure right now, but as always, utilizing our evaporative cooling wall that has a really significant impact on keeping operating temperatures cooler. So we are very excited to see these buildings built out here in the coming months. What percentage of total miners are outdated, awaiting deployment, and operating? So first, our entire fleet is the S19 series Antminer from Bitmain. That is the latest model from Bitmain, the S19J Pro and the upcoming S19 XP Pro that we've ordered. Those are all the lowest efficiency, the most efficient miners out on the market. So we're very proud to have a real state-of-the-art fleet of mining hardware. As far as the different deployment figures, we just put out our monthly update yesterday that summarized where we're at. We have right now 42,455 miners deployed. We have 6,324 miners staged for deployment, ready to be deployed in our immersion cooled building, Building G. We have 6,333 miners that have been shipped from Bitmain and are currently in transit to our Whinstone facility. And on top of all of that, we have miners that are in inventory waiting to be staged for deployment as well. Why do most public miners hold Bitcoin through bull markets only to sell them in bear markets? Well, I think it's common market psychology. Holders of an asset, especially something like Bitcoin that the holders are long-term believers in, they want to realize that full price appreciation. When they see the price continuing to go up, you want to hold on to that and get as much upside as possible. Now, if you have certain debt obligations, or you haven't previously, financed your business, financed the growth options in front of you, you then get in a position where you would have to start selling Bitcoin, an internal source of financing to help finance your business. Now, Riot, we are long-term believers in Bitcoin, absolutely. That's why holding Bitcoin on our balance sheet is an important part of our strategy. And we've continued to increase our Bitcoin holdings. We are not, however, entirely inflexible on selling. We have been selling part of our monthly production that helps pay for operational expenses and capital expenses growing our business as well. So what's important though about Riot is that we have the flexibility to choose when we are going to sell Bitcoin. We aren't forced into selling Bitcoin because of some onerous debt terms that we hold. We make a discretionary decision on selling Bitcoin on an ongoing basis. How long is the company going to be paying Coinmint for hosting? So we recently announced that we are ending our hosting relationship at Coinmint. This is a part of our vertical integration strategy, having all of our miners controlled over our own fleet. And it's a part of our strategy of having as low of a cost of production as possible. So while we never, the hosting terms with Coinmint were confidential, there was a performance fee that we paid that was a percentage of our gross profit. And now ending that agreement and bringing all of our miners under our own control, we don't have to pay those incremental hosting fees anymore, and we get to take advantage of the low cost of power that we have at our Whinstone operation. Do you plan to consistently sell Bitcoin to fund operations, or is there an intention to hold Bitcoin on your balance sheet? Holding Bitcoin on our balance sheet is an important part of our strategy because we are long-term believers in Bitcoin, and we believe holding onto that Bitcoin will allow us to benefit from the future price appreciation that we expect. Now, we have started this year selling a part of our monthly Bitcoin production. So we've been bringing in capital on a monthly basis while also incrementally increasing our holdings. We want to continue to increase in our holdings. The decision between holding and selling is one that we're kind of making on an ongoing basis. And what drives that is our cost of capital, driven by current market conditions and what our current financing needs are. But we are absolutely believing that holding Bitcoin on our balance sheet is an important part of our strategy. Do you envision M&A, so mergers and acquisitions, during a bear cycle, or does Riot foresee itself participating in any mergers and acquisitions, whether to secure additional hash rate or further vertically integrate on our supply chain? So great question. I think if you look at the competitive landscape, Riot has been more active in acquisitions than any other player in the space. In 2021, we acquired Whinstone. And at the end of 2021, we acquired a company called ESS Metron, who engineers and manufactures electrical equipment. It's one of the key vendors to Whinstone. So as you noted, as the person who asked the question noted, that was a part of further vertically integrating ourselves and taking control of our supply chain. So because of our strong balance sheet, because of the scale we operate at, we believe we are in a good position to be an acquirer of assets during any market cycle, but particularly a bear market cycle. So we are evaluating opportunities all the time. There are no definitive plans right now, but we are evaluating these plans all the time, and having the flexibility to look at these opportunities and pursue them if we believe they're accretive is very important to us. I can't tell you what the future is going to hold, but it's likely there are going to be opportunities to acquire distressed assets with hash rate, and I think there will always be opportunities in the vertical integration space as well. Why did you change your investor presentation this month from assuming a constant Bitcoin price to assuming the Bitcoin price will grow to 200,000? Why did you change the assumed lifetime of your miners from 10 years to 5 years? These assumptions seems optimistic. What would your projection look like using the previous assumptions with the $20,000 Bitcoin price, 5-year miner lifetime? Okay, so first, we did not assume a miner lifetime in that. What you're seeing on that slide of the deck is a projection of how long that miner would be profitable during the projected market conditions. Just want to clear that part up. The bulk of your question though is why do we change the price assumption? So we are trying to put out a model that compares two Bitcoin mining strategies. And to anyone who's not familiar, this is a slide in our deck. I couldn't tell you the slide number off the top of my head, but it's comparing a vertically integrated and non-vertically integrated strategy, that is owning your own infrastructure versus relying on a hosting provider to host your miners. And we have a slide analyzing the financial impact on that. And in that slide, we have a model that makes a number of assumptions. Now, with Bitcoin mining, that's always difficult because we have two key variables here. We're trying to make a model forecasting out as long as possible, and what's going to play into that is both the price of Bitcoin and the network difficulty. Now, there's no source of truth on what the future price of Bitcoin is going to be, but there is a lot of work and third-party estimates on what that growth in network hash rate is going to be. So in that model, we relied on third-party projection of what that growth of network hash rate would be. However, that assumption is based on the price of Bitcoin increasing as well. If the network difficulty, if the price of Bitcoin is not increasing, then the margin for Bitcoin is decreasing so much that the network difficulty, the network hash rate would not be growing. So if you're going to try to be as accurate as possible in these type of projections, you need to have a forecast on how the network hash rate will grow, because it's expected it will continue to grow as it has for the 13 years in Bitcoin mining's lifetime and grow substantially. But the reason it has grown substantially is because the price has appreciated substantially as well. So we have to try to pick some future price to go alongside that. Otherwise, the alternative would be to just assume a constant Bitcoin price, a constant network hash rate / network difficulty, which I do not believe would be an accurate way of forecasting it. That would just be saying, you think Bitcoin margins are remaining constant forever. We are factoring in, future halvings in that model. We're factoring in how, like I talked about, how the network hash rate will increase. So there's some projection in the Bitcoin price that's needed as well. So in that model, under those assumptions, the S19 XPs would continue to be profitable through the full 10 years of that model. How the future will play out, hey, that's very hard to see. But the purpose of that model was not to forecast Riot's financial performance. The purpose of that model was to compare two different strategies for Bitcoin mining. One, owning your own infrastructure, and the other being relying on a third party for hosting services. What is the true cost per Bitcoin mine? Can you go into details, please? So to start, I think it's important to understand that not all SG&A and depreciation amortization expenses you see in our financial statements are expenses related to Bitcoin production. We have costs and resources in those buckets that are deployed to all the segments of our business, which includes hosting, which includes engineering, and self-mining as well. So it would not be accurate to take those top line summaries of those expenses and apply those only to Bitcoin mining, or only our self-mining segment of our business. It is really challenging for the market and for analysts to compare different public company miners out there on a cost per Bitcoin basis, because everyone uses a different depreciation schedule. And that'll dramatically change if you're factoring depreciation and amortization into the cost of Bitcoin. That's going to dramatically change what your cost of Bitcoin is in the years when the depreciation is being expensed and when the years it is not. So if you look at Riot, for example, we use a 2-year depreciation schedule. That's a very fast depreciation schedule. Obviously, we believe the useful life of these miners is going to be well beyond those 2 years. And history has demonstrated that's the case. You see the S9, for example, running competitively for the better part of 6 years now. And improvements in the hardware are only slowing down. So if you take a company like Riot that has a 2-year depreciation schedule and you try to compare it to a miner who's maybe using a 5-year depreciation schedule, you're not really having an apples to apples comparison, and that doesn't really give you a good picture of their relative operating efficiencies. So when we look at our cost of Bitcoin mined, the way we look at it and the way we compare ourselves to others is on our direct cost of production. That is, what is the direct expense that we have to pay to mine a Bitcoin? And for us, for the first quarter financial results, that was approximately $13,590 per Bitcoin. And that cost is mainly comprised of the energy costs that we incur during that quarter, which is the primary operating expense for Bitcoin mining. How do you keep your company operating positively as the Bitcoin price drops? It's all about keeping a low cost of production, and that's one of the principal reasons that we acquired Whinstone last year. Whinstone has a large, low-cost, long-term power purchase agreement and a really innovative power strategy that's made possible in a free energy market like ERCOT. So for the first quarter of 2022, we reported an average power cost of approximately 2.9 cents per kilowatt hour. And that is one of the lowest power costs out there for Bitcoin miners. So by having that low power cost, we're able to maintain a margin, or anticipate maintaining a margin, as the price of Bitcoin fluctuates and the network difficulty, in other words, the network hash rate, fluctuates as well. As long as you can remain being one of the lowest cost operators, then the market conditions, they can scale up and down, but you are able to, hopefully continue to secure a meaningful margin. There was a question about, are we staking any of the coins, or do we have any expected returns? No, not at this time. We haven't staked or lent out any of our Bitcoin. And I think if you look at what's going on in the market right now, you see why that's so important. Hey, that yield is what it is for a reason. So we've taken a conservative posture so far. We custody all of our Bitcoin, and we haven't lent it out to any third parties. We will continue to look at treasury management options, so our door is not closed to that, but at this time we're not involved in staking or anything like that. Are you actively lobbying for a change in GAAP rules for crypto? If so, when do you feel these changes will be made? Great question. Obviously, the GAAP rules right now are very challenging for public Bitcoin miners, or anyone that's using GAAP accounting on their financials. To those of you who don't know, when the price of Bitcoin goes down during a financial reporting period, if that price is lower than what your previous cost you were holding that Bitcoin at on your balance sheet is, then you have to take an impairment charge against your net income. Now, that happens if Bitcoin goes down. If it goes back up, you do not realize any of that benefit. So the way the accounting rules are right now, you can only mark your Bitcoin, the value of your Bitcoin holdings down and never up. So that's why when you look at our financial statement, you'll see a value for cryptocurrencies that is actually less than what the market value of the Bitcoin we hold is. Now, obviously, we believe it's important for these rules to be changed. I don't exactly know the thinking why these rules were made the way they were in the beginning, but we do know of, and we are supportive of efforts being made to lobby FASB to adjust these rules here. These types of changes do not happen quickly, unfortunately. We expect a multi-year process, but we will certainly do what we can to support education efforts and hopefully support an adjustment of how these rules are applied to Bitcoin mining companies, or all Bitcoin companies. Question, when you remove the old miner count from the pool, I think you mean from our deployment figure, can you describe the plans to reintroduce them either at Whinstone or Navarro as either self-mining or lease capacity? So I think this question is asking about the S17 miners that we removed from deployment, we noted in our last update. The S17s are a generational miner that came out in 2019, and they're less efficient than the S19s. And one of the initiatives we're undertaking is taking those offline, refurbishing those miners, and then redeploying them in immersion cooling. And we believe by doing so, we are going to increase the economics of those machines, increase their output, and increase their useful life. I don't have a timeline of how long that will take. That's something that we're working on now. It's not something that's been really done at a massive scale as far as we're aware yet. So we're kind of, I think, leading the charge here. So we're figuring this out. And The intention would be to redeploy those miners either in our immersion cooling at Whinstone or in our immersion cooling in Navarro County / Corsicana when that infrastructure is completed. Why are you behind your own published schedule for exahash deployment? So there's a lot of things that go into miner deployments. We started these deployment schedules based on our shipments and when we expected the infrastructure would be ready to receive those shipments and deploy those miners. Obviously, there's things going on in the market, there's things going on in supply chains that impact that all the time. There are things going on that change construction schedules. So while that has changed what our initial thinking of our deployment schedule was, I'd note that we do continue to deploy miners on a monthly basis. We have proven our capability to execute here in building immersion cooling infrastructure from scratch. 1 year ago, our idea of building an immersion cooled building or 2 buildings was just an idea. And we're sitting here today with the first building full of 23,000 miners now complete. So that whole project was completed on a very rapid timeline, 12 months from conception to completion. That's something that we're very proud of. We believe by continuing to do this, now kind of blazing the trail and building this type of infrastructure, we've figured out ways to be faster, to be more efficient, and we believe that is going to help make deployments more regularly, happen on a quicker, more rapid pace going forward.